How many myths do you believe about the mortgage industry? Is there a chance you've been running around with bad info in your head that if you got right, could actually make you a lot of money in real estate? You've also heard that perfect is the enemy of progress, and that can very well be true. Sometimes we get stuck in analysis paralysis because we're trying to do everything as perfectly as we can. We've come to the right place. On the BiggerPockets Mortgage Monday, my partner Christian and I dispel these mortgage myths, how you might be looking at BRRRRs the wrong way, how Christian and I look at them, and how we've helped thousands of other clients to look at this in a better light and then give you the truth so you can make better decisions. All that and more coming up on today's show of Mortgage Mondays. What's going on, BiggerPockets fandom? You are in for a treat today if you're looking to learn. I'm David Greene, host of the BiggerPockets Real Estate Podcast, here today with my partner in the one brokerage, Christian Bachelder, here to bust more mortgage myths. Christian, welcome to the show. How are you today?
Pretty good. Happy to be here.
Glad to hear it. All right, let's get into this thing. Myth number 1, I want to BRRRR my primary residence. Isn't this a great idea?
Yeah, it's one we get a lot, kind of shockingly. And I think people forget the ultimate point of BRRRRs is to buy a property and get most of your money out. Where with the primary, you can put 3 to 5% down to start, right? So you're kind of already at the exit of the BRRRR in most cases. Now, is there a value to, value adding and, bettering the value of your property? Of course. But using that BRRRR strategy, particularly for that cash out refinance at the end, you kind of already start with that really high leverage, right? Which you kind of have the fast track, right? You don't always need to BRRRR primary.
That's a great point. Ideally, you want the juice to be worth the squeeze. And BRRRRs, though they're great, we love them. We do them all the time. They're work. There's no way getting around it. You can get a home for 3.5% down. You don't have to go through the headache of a rehab, try to find a fixer-upper, managing a contractor, going over the timeline, having things go wrong and losing money. Just buy a primary residence every year if possible. Which leads us to mortgage myth number 2. BRRRRs are supposed to be perfect. Did someone fail if they did not have the perfect deal?
This is by far the most common question we get with BRRRRs. When people say the perfect BRRRR, that means they're able to cash out 100% of the money they put into the deal, right? So whether that's a down payment and the reno, or if you're just refinancing, maybe just the reno, but that doesn't mean you failed. Right? I mean, if you can get 75, 80% of that cash you put into a BRRRR back out, that's still a win. You still ended up putting very little money down to acquire that property. Some people even shoot to cash out more than you put into the project. Obviously, that's an absolute grand slam. But no, I would definitely not classify a BRRRR as a failure if you do not get 100% of those funds back. Still a very powerful strategy.
Yeah, I've been preaching this from the Raptors for years, and I said Raptors, not rafters. I've been preaching this from the rafters for years. The baseline for a successful BRRRR is not that you got 100% of your money out. That is an incredible deal. And if you get more than your money out, so much the better. But that ends up being the only examples that get talked about. Someone comes on a podcast, they want to share their huge wins, the one deal out of 10 that worked out that way, and everyone thinks, oh, that's what you're supposed to do. No, a win in BRRRR is anytime you get more of your money out of it than you would have spent if you just bought it traditionally. So in other words, if the loan to value is advantageous through a BRRRR than it would have been if you just bought it and then dumped all your money in the rehab, that's a win. You did better. Now, of course, there's big wins, there's small wins, there's medium wins, but it's still a win. So quit thinking that you failed on a BRRRR if you didn't get all of your money out. Normally, you'd have had to put 20% down or more. You'd have had to pay whatever, $30,000 to $100,000 for a rehab. You can just get your rehab money out of the deal and you're still 80% loan of value. That's still a huge win if it's the equivalent of putting 20% down. So remember that, everybody. It doesn't have to be perfect. All right, mortgage myth number 3. Running someone's credit will ruin their credit score. Christian, what say you about this terrible mortgage myth?
Yeah, super common objection that we get. A couple different ways to solve it. Number 1, guys, when you run your credit, it doesn't hurt you the way you think it does. Usually it hurts you 1 to 3 points, but every month of successful payment history you build up increases your score by 1 to 3 points. So you're basically setting yourself back 1 month of credit report. That's the benefit of obviously getting you a pre-approval to potentially get you into a property. That's worth it. And lenders on top of that have set protections to make sure that you have some flexibility in your credit score by pricing in brackets of 20. All I mean by that is if you have a 700 to a 720, you get the same rate. So dropping from a 720 to a 717 is not going to significantly impact your loan. And in the event you flip over those brackets, we have credit restoration services to get you into the next one. But absolutely not to the level that people think running their credit is detrimental to their file. It's not the case.
Now, when you drop from a 720 to a 717, hypothetically here, does it stay a 717 for the next 4 years?
Absolutely not. That's what I was saying. With every payment of good payment history, you're getting that 1 to 5 points back anyways. And you guys try this with your credit, right? Pay your credit cards and see your score go up, right? Keep your balances low, see your score go up. Credit is on this revolving basis every month. month. I can tell you guys just personal experience, being a broker, getting approved in multiple states and buying a number of properties that I do. I have, I think, 26 inquiries on my credit report in the last 48 months, in the last 2 years, and my credit's 780. So like, if pulling your credit hurts your credits, it's not happening to me, right? So just keep that in mind. That's more than one a month that I've got in the last 2 years. Still have good credit.
At a certain point, yeah, right? Like if you just were massacring your credit every 2 months, running it again in perpetuity, it could get to a point that you couldn't keep up with, but nobody ever does that. That leads us again into mortgage myth number 4. My score drops every single time I run my credit. So if I've already run it with one broker, I shouldn't come to another broker to do the same thing.
Yeah, and definitely a myth. The mortgage industry is built for people to get multiple quotes, right? Experian, TransUnion, Equifax, all the credit bureaus understand that. Typically, there is a 30 to 60 day grace period where multiple mortgage credit inquiries will count as one. So you could go to Chase, Wells Fargo, us, right? And you can get multiple credit pulls and it will only impact your credit one time. Now, just like David was saying earlier, if you go run your credit in perpetuity, yes, that 30 to 60 days is always kind of rolling over. People think like, oh, does it just extend because I reset the clock? No, but if your mortgage credit pulls are actually converting into purchasing houses, it's actually good for your credit long term because you're building up installment debt. You're building up a good payment history. What can hurt you and why mine didn't, I use my example of 26 and 24 months, is that I actually went and bought stuff, right? So I'm offsetting my credit pulls with good payment history. And now I have so many credit accounts that like every month I make one good credit payment, like it's really good for me. Right? Don't just go pull your credit every month to keep your pre-approval up to date and never buy a house, right? That's not good for your credit. Right?
Yeah, that's a good point. A lot of people get put in touch with their loan officer, whoever it is, through someone else. That's a person on BiggerPockets. It's a name they've heard. It's their realtor's recommendation, but your realtor often has no idea how loan stuff goes. They barely know how to do their own job. And I can say that confidently because I am one of them and I see exactly how much incompetence lives in that realm. So if you're hearing this and you want us to run your credit and look at your loan and see if we can get you pre-approved, or you have another person who came across your path at a meetup and they sound like they know their stuff. If you run it, what did you say it was? Was it 45 days?
It's usually 30 to 60.
If you fall it definitely within that 30-day window, have another pre-approval issued by another lender, see if you like them more, see if they have better loan programs, and there's no penalty to you. And that really came about from the last mortgage meltdown that we had that led to a horrible financial crisis where I believe it was the Obama administration put it into law that we don't want people running their credit and afraid to get another quote from another lender because of predatory lending out of fear that their credit was going to take a hit. So they made it so you have that 30-day window to do so without it. Now, personally, no one asked me, but if someone did, I would say this is a stupid way that we do credit in America. It makes no sense to me that if you want to know what your credit score is, that you get dinged for that. It's like a bank charging you every time you check your account balance. I don't understand it. Oh, you look to see that you have $700 in the bank. We're going to take $5 away because you looked. I don't understand why they do that, but they do. I also don't understand why these 3 companies, what is it? Equifax,
TransUnion, Experian.
Thank you, TransUnion, Experian. They are private companies that control exactly how credit works in the entire country. There's a lot of things they don't take into consideration. If you've made utility payments on time, if you've made rent payments on time, there's a lot of things that aren't official lines of credit that do not get factored into this that really should if you're looking at the whole picture. So the whole credit system is kind of a scam. So find yourself a loan officer that knows how the stupid scam works so they can protect you from the downside.
So that you can scam the scam.
Scam the scam. That's exactly right. You got to learn how to play this game if you want to make money in our world. And that's what we're teaching you here at BiggerPockets. All right, mortgage myth number 5. I can't wrap rehab costs into my loan. There's the loan and then there's the rehab. They will always stay separated like an angry married couple that sleeps in different bedrooms. Christian, is there a way that we can take these 2 couples and have them sleeping in the same marriage bed again?
Yeah, there are, but I want to be very specific here. Not for every loan product, right? So if you're just getting a standard conventional loan, an FHA loan, a DSCR loan, all these things that you've heard us talk about on the series. No, however, there are renovation loans. Mainly 2 categories. There's a conventional one and there's a hard money one. Hard money one's the one that most people use. You put 20% down on the purchase and you get the renovation financed. As long as the property appraises high enough after you do the renovations, you're good. That's a standard hard money or bridge loan, some people call them. It's short term. You get in and out of it. You do your renovations and refinance into a better product. The one that everybody's going to be interested about is there are conventional and FHA options. The FHA is called the 203K. The conventional loan is called the home style renovation loan. It's an offering through Fannie Mae and Freddie Mac. And that allows you, same thing, to get an after repair value appraisal. So you get the appraised value of after the property is renovated, and you can get funding based on the percentage, loan to value of that after repair value, not the current one. And you can use that margin to do the renovations on the property. There are a lot of restrictions. There are upfront costs. So it's not just rainbows and butterflies. You guys are interested in that loan product, reach out to us. We do offer it. It's more difficult than a normal loan. There's going to be a lot more involvement and cash upfront that is required.
Yeah, there's a principle that I've learned when it comes to real estate in general. I call it easy in, hard out, or hard in, easy out. It applies in several ways. So for instance, if you're a real estate agent, the leads that come to you the easiest, like you buy them on Zillow, are the hardest to put into contract. They're very difficult. And then the loans that are the hardest to get, like you go out there and you meet real people, you cold call, you talk to your friends and family, you meet someone at open house, they're way easier to put into contract because they have better expectations. I see this with properties. Very easy to buy luxury property that's been sitting on the market for 250 days, but then it's hard to sell it. There's less buyers. And it's very hard to get into the best deals out there, but once you have them, they're very easy to get out of. I tend to look at loan products the same way. There are certain loan products that are good for the long term. Something like the 203K loan or the home style loan, they're great for the long term. They're incredibly difficult to use to get a property. Then there's other loans that are much easier to use to get a property. These would be bridge loans or hard money, especially when you can borrow money from the rehab and put it in the loan, but they're bad long term. So you're going to have to refinance out of them into a better loan. My personal take on this is you're better off to use a loan that makes it easier to get into a property for the short term than refinance out into one of these other products that are better to hold for the long term, rather than using one of the products that are good for the long term, like the 203K, and trying to force your way into the deal with them in the beginning. What do you have to say about splitting it into two stages to make it easier versus trying to use one loan product for both?
Yeah, I couldn't have said it better myself. The barrier to entry of 203K, home style, right? These loans that they're kind of like trigger words, like, I can put 5% down and get my renovation finance. What a miracle. Yes, that product technically does exist. The likelihood of you qualifying or the property working or being able to front the upfront expenses, because you got to pull permits, get designs, get drawings, get, sometimes zoning work done. Every barrier to entry that you initiate on the front end makes it harder to get to that easy on the end, like David was saying, right? Whereas the other way around, you do a classic bridge loan, super easy on the front end, and then you just refinance, right? You piecemeal it, like you said, right? And you can go get a good 30-year fix, which is how most flippers, renovators, a lot of BRRRR people, there's a reason why one of the R's in BRRRR stands for refinance. There's a reason why it's there, right? You don't get a loan up front that covers everything.
Great point.
Right? I mean, there's a whole letter dedicated to it, So typically, historically speaking, that's the best way to do it.
Yeah, don't leave one of the letters out of the BRRRR. You mess it up, right? Don't take one of the tires off the car. Don't leave one of the ingredients out of the cake, and don't take one of the letters out of BRRRR. You will regret it. That's a great point. All right, Christian, thanks very much, man. I appreciate you helping me dispel some of these mortgage myths, because quite frankly, like many things in real estate, what you hear about is often clickbait. People are going to tell you about some new cool strategy that you can get a great deal on, or some approach to real estate that no one else has heard about, without telling you how ridiculously hard it is to execute. Well, the same is true for mortgages. People are trying to get you in their funnel. Doesn't have to be that way, everybody. Thank you for your time. Thank you for your attention. And thank you for learning from us. Christian, if people want to find out more about you or reach out to learn about what you can do to help them, where can they find you?
Yeah, The One Broker on social medias. My email is christian@theonebrokerage.com. And that's also our website, theonebrokerage.com. Find out more.
And then you can follow me at David Greene 24 all over social media. Please do. We want to hear from you. We want to keep you from getting ripped off by bad loans. You can also follow this channel by subscribing at BiggerPockets here. We have lots of content, more than just the podcast, that we want to educate you with, because we care about your financial future. Lastly, you can check me out on YouTube Live every Friday night at youtube.com/@DavidGreene24. Christian is frequently on there, and we are dispelling more myths and talking about how you can build your wealth. Thanks, everybody. Check out another video and go subscribe to the BiggerPockets podcast if you haven't already. See you on the next one.